Hi, it's John Kelly. This is the continuation of the module on Rule 204, Prohibitions, Part 2. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. So 204.425 long rule, you're not allowed to do valuations, period. There are limited exemptions, but they would normally be not applicable. The valuation has to be kind of insignificant. And this is one not to try to get around. I had a colleague phone me one day and said, understand there's a new rule that says our firm can't do valuations for our audit clients. And I said, that's correct, you can't. And he said, well, how do we get around that? It's really inconvenient for business reasons and we're not going to make as much money as I'd like to make. We need to be able to do valuations. And I said, well, you can't get around it. He said, well, I'm going to try to find a way. We're just going to do it. And a couple of years later, he phoned me and practice inspection had arrived and found out about it and told them they couldn't do it anymore. And they had some significant problems as they tried to unwind what they had done. So don't do it. You also cannot provide actuarial services. You also cannot provide internal audit services. Though there are limited exemptions, you certainly can write an internal control memo. You're required to by professional standards. But you cannot take over the internal audit department because you'd end up reviewing and improving and recommending stuff that we're not supposed to do as auditor or reviewer. Also can't provide IT services. There are limited exemptions, but basically we can't provide IT services. Cannot provide litigation support services. And this is defined as you can't do something to advance the client interests. You can't be a lawyer. The firm or the member, not allowed to be the lawyer. You're kind of wondering, but some of the big firms decided that they had this wonderful idea that they would be law firms and actuary firms and litigation support firms, and they do all these services and provide them all to their audit clients. And that they thought that wouldn't affect independence. The rules were then written to say, well, an interesting idea, but you can't do that. Now, there is some litigation support stuff you can do. I know of one firm that has a big document organization and delivery service, because in a large lawsuit, there could be many documents that the lawyer would need in court, and they organize and deliver those documents, have them all indexed, and can do that. You can be an expert witness, but if you are an expert witness, you cannot be advancing or promoting the client's interest, just the facts, no bias. So if you are an expert witness and there is part of your testimony that might damage your client's position, you have to answer those questions. You have to tell the judge. So that's something an expert witness has to do anyway. You are actually working for the judge and the court. You're not working for your client. And if the judge finds out or starts to come to the opinion that you're biasing your testimony in favor of your client, he'll throw you out of court. And there was a lawsuit a long time ago now. Senior member of the profession in our town was testifying as to the difference between audit review and compilation. And some of the things he said didn't necessarily help out his client, but he was clear, he was factual, he explained it to the judge. And at the end, in the written opinion, the judge said, you know, I accept this guy's testimony. It was clear, he explained it to me. The other two expert witnesses were biased. They were trying to promote their client's interest. I'm totally ignoring their testimony, and I'm going with this guy's testimony. Now, if you were an expert witness and you biased yourself like that, you're going to get in trouble with the judge first. You're going to get in trouble with your client second when the judge throws your testimony out of court. And then, icing on the cake, you're going to get in trouble with Rule 204.429. So if you want to be an expert witness, just the facts, no bias. And to be even more clear, 30 and 31 say no legal services of any kind whatsoever. HR services, be careful. Generally, the rules say you can't do them. You can give some help with recruiting. If you're going to get involved with HR services for a client, read the rule. Corporate finance, promoting, dealing, and underwriting, those guys make a lot of money. It would be wonderful if we could do it, because then we could make a lot of money not being auditors. The rules say we can't. Probably the correct rule. Tax planning is not okay, F, and all of these three circumstances have to be present. The effectiveness of the plan depends on the accounting treatment. That sounds like a bad idea. The consequences have a material effect, so we're recommending something that will materially impact the financial statements, and then we're going to try to audit it. Also sounds like a bad idea. And finally, there is reasonable doubt about the accounting treatment. Well, that sounds like a really bad idea. So we have to have all three of these really bad ideas present if we want to do tax planning, or we should not do tax planning. So it sounds to me like this kind of tax planning just shouldn't be done anyway. Now, for a public company, we cannot prepare, and remember the difference between prepare and propose, the tax calculations for current and future tax. And anyway, that's in the story I told about earnings per share. The client should come up with it first, because if we come up with it, we just might do it wrong. And if the client can't look at it and go, hey, you've done that wrong, it's going to go into the financial statements wrong. So clients should do, we should review, and if we want to change it, the client should be very sure that we've got it right. We can prepare tax returns, though there's some indication that that may be considered to be an independence threat. In the current situation, though, be sure you get management to approve the financial statements. That's the same theory. Anything we do, we propose and we get management to approve. Normal tax stuff is okay. Doing a salary versus dividend calc to help the client out, that stuff's okay. Far out tax stuff, not okay for a variety of reasons, all bigger than the rules of conduct, the code of conduct, but still against the rules of conduct. Tax advocacy. So providing facts and information. This is a fact. This is the information. Here is a relevant section in the tax law. That's okay, and that's not advocacy. Acting as an advocate, actively promoting a client's position, whether it's right or wrong, not okay, and we probably don't want to do it anyway. I wouldn't want to do that. You're sticking your neck out. That's what lawyers do. That's a lawyer's job. They're very specifically required to advocate their client's position, whether they believe it or not. That's their job, to act as the client advocate. That is not our job as auditor, and we shouldn't do it. The rule's complex. Be very careful. Read the rule. What do you do if you've done evaluation, or you've done internal audit, or done any of the other things that we're not allowed to do in 22 to 34 because the client wasn't an audit client at the time? So there are some safeguards here. Discuss independence with the audit committee, the client to review and accept responsibility for what we did, and the people who provided those services are not allowed to be on the audit team. So just be careful. If you're providing valuation services for a non-audit client, you might just want to think about what might happen if they became an audit client. No lowballing fees. It's a bad idea anyway, other than the fact that it's not allowed in the rules. If you do quote a fee, you have to be able to demonstrate that you will devote enough time and staff to the engagement, no matter how much you're billing for it, and that you will follow standards. I'll tell a story about a client that became a client of our firm. One of my partners had done this audit when he was a partner at a mid-sized firm. And after he'd been a partner at our place for 3 or 4 years, the client decided, maybe they'd like to switch. and they wanted to get fee quotes. And I'll kind of make the numbers up, but you'll get the scale and proportion. We bid, let us say, $50,000. The mid-sized firm bid $60,000, and that's about right. They're bigger, got a bit more overhead, more management than we do, so $50,000 was the right number for our firm, and $60,000 was the right number for the mid-sized firm. And the controller, who was a friend of mine and a friend of my partner's, phoned up and said, "You'll never guess what the big firm bid." And I would have thought $80,000 or $90,000, knowing what their billing rates are and their overhead and stuff like that. And, you know, there's prestige to having a big firm audit on your audit report. And some people are prepared to pay for that. Some people like the prestige of a middle-sized firm, and other people like the, shall we say, prestige and low fee of a small firm. Anyway, the controller said, yes, they bid $20,000. Nowhere near enough. They're obviously lowballing. And my partner said, well, what did you do? He said, well, I phoned him up and said, okay, I should have made this clear. I want a quote for 3 years, and I want you to tell me what's going to happen to the fee after 3 years. So he asked that question of my partner, and my partner said, well, you know, we bid 50. It'll be 50 plus a little bit more for inflation next year and a little bit more for inflation the year after that, but no, 50 is the number we're going to bill. And the mid-sized firm said the same thing. The big firm stumbled and mumbled and grumbled and 40, no 50, no 70, no, we're not sure. And they didn't get the work. And that story went all around town and everybody heard about it. So it was a bad idea for a whole bunch of reasons. First, they didn't get the work. Second, they had mean stories told about them all over town. And they were lowballing, and they probably shouldn't have done that. Probably was against the rules. Anyway, don't do it. No contingent fees. I see people try to find all kinds of wonderful ways around that rule. You can't. Don't do it. No contingent fees. There is a rule about the size of the fee from a single client that can affect firm independence. And I will tell you a story. That rule had always been there, but no number, no bright line test, no 12%, 9%, 4%. But it said a significant fee. So my theory was, well, significant must be different from material, and material's 10%, so 15%. And I put that in the form that we fill out to evaluate whether or not we have an independence problem from the size of the fee. And a couple of my partners came and went, 15%? Are you kidding me? That's ridiculously high. There's no client of ours that's bigger than 2 or 3 or 4%. Can't imagine it being 15% of firm revenue. And I said, well, you know, told them my story, and they went, oh, well, okay, you're a funny guy. We'll just put that there, and we'll see what happens. We'll see what the practice inspector says. We'll just see. So 5 or 6 years later, when they put a number in, and the number was 15%, I went, see, I was right. I suggest you have that as a checklist step as you evaluate your independence every year on every audit review. And the number is 15%, which is a really high number. Partner compensation. You cannot compensate partners based on solicitation or sales of non-audit services to audit clients. Can't do that. Okay. What can you do? Well, you can compensate partners based on performing services, for instance, fee volume or increases in fee volume. You can compensate partners based on sharing the profits of the firm in accordance with whatever profit sharing formula you have. And you may take into account the complexity of a partner's assignments. You may take into account the management of the client relationship, including providing non-audit services, which is a very subtle difference. You can take into account attaining of sales goals. I guess we just won't point out that they are non-audit sales goals. But you can do that, and you can compensate based on sales of other services. This, this should be on a form. We do not compensate partners based on sales of non-audit services to clients. Instead, we consider performing services and the 4 points there. So there's 5 different points, I guess, include sharing profits of the firm. Perhaps that might be part of the annual quality control evaluation. We are evaluating our process for evaluating partners and paying partners. And here are the 6 things that we take into account, and we don't do the other one that we're not supposed to do. 39, gifts, hospitality, and discounts not allowed. A coffee mug, insignificant, is okay. Accepting a cruise from a client for you and your family and going to Disney World is not okay. That should be obvious. Conflicts created because of a merger or acquisition. Either you've merged with someone else or a client has merged with someone else. It's a complex rule. There are some safeguards. Need to read the rule if you're in that very complex and unusual situation. So, as I've said before, read, understand, and follow the rules, all of them. You have to read all of them and read them together. A lot of this, I think, should be obvious. Some of these things that I've talked about, like how you should be an expert witness, you have concerns much bigger than violating the rules of professional conduct if you take the client's side. So, should be obvious anyway. And anytime you try to find ways around the rules, like my colleague did on valuations, that's a bad idea. So, thanks for listening.